Good to have you here. This is Unintended Consequences, episode 54. It's July 10th, 2026, Friday. Let's wrap the week with a story that has a real lesson in it. The 1968 National Flood Insurance Program set out to limit building in flood prone areas, but instead subsidized far more development behind levees. In August 2005, water overtopped and breached levees around New Orleans that federal maps had labeled adequate for a 100-year flood. Behind those levees stood neighborhoods, businesses, and infrastructure that had grown steadily since the National Flood Insurance Program began offering subsidized coverage in 1968. The program had been created to make flood losses manageable and to steer construction away from the most dangerous ground. Instead, the combination of affordable premiums and the visible presence of levees produced the opposite result. After repeated catastrophic floods in the 1950s and 1960s, Congress looked for a way to shift some of the financial burden from general taxpayers to property owners while still providing relief. The National Flood Insurance Act of 1968 created a federal program that would sell policies at rates intended to reflect risk, but only in communities that adopted basic floodplain zoning rules. At the time, private insurers had largely withdrawn from flood coverage because losses were too correlated and too large. When an entire river basin or coastal stretch floods at once, the claims arrive in one correlated wave rather than spreading across years and regions. So the arithmetic of pooling risks simply did not work for private carriers. Policymakers, drawing on work by geographer Gilbert White and others, believed that requiring local land use controls in exchange for insurance would gradually steer new construction toward higher ground. The approach seemed practical because it acknowledged that some development already existed in floodplains and offered a mechanism to manage future growth without banning building outright. Rather than drawing an absolute line that would have required condemning existing homes and businesses, the law treated the floodplain as a zone where rules could be applied incrementally, one permit at a time. The program began operations in 1969 under the Department of Housing and Urban Development and later moved to the Federal Emergency Management Agency. Communities joined by agreeing to regulate new construction in the 100-year floodplain. In return, residents could buy policies whose premiums were often well below actuarial cost for older structures. Early participation grew slowly, then accelerated after major floods in the 1970s prompted Congress to make coverage mandatory for mortgaged properties in participating areas. Proponents noted that thousands of communities adopted ordinances they otherwise might not have passed. Skeptics, including some state officials and floodplain managers, pointed out that the maps used to set rates were often based on existing levees and that the 100-year standard still permitted substantial building once a levee was certified. The maps treated the levee as a fixed line on paper, so any parcel behind it was reclassified as lower risk even though the structure itself could be overtopped by a larger event. That reclassification immediately changed the premium calculation and the mortgage underwriting rules that followed from it. Once levees were shown on maps as providing protection, land behind them became eligible for lower insurance rates and easier mortgage approval. Developers responded by building more densely in those protected zones, increasing the total value exposed to a levee failure. The program's subsidies for pre-existing structures kept premiums low enough that owners had little financial incentive to elevate or relocate. Over decades, a class of repetitive loss properties emerged, structures that filed multiple claims yet remained in place because each repair was cheaper than relocation and insurance continued to cover the difference. When Hurricane Katrina struck in 2005, the NFIP faced claims that pushed the program more than $17 billion into debt. The causal chain ran from subsidized insurance and certified levies to greater investment, then to larger losses when the protection was exceeded. Second-order effects included political pressure to rebuild in the same locations because the same maps and the same insurance rules were still in force after the water receded. Third-order effects included rising program costs that eventually required Treasury borrowing because the accumulated claims could no longer be covered by premium income alone. The Biggert Waters Flood Insurance Reform Act of 2012 directed FEMA to phase out many subsidies and to update flood maps more aggressively. Premiums began rising for some policyholders, prompting immediate backlash from coastal and riverine communities. In 2014, Congress passed the Homeowner Flood Insurance Affordability Act, which restored many of the discounts and slowed the transition to risk-based rates. As of the mid-2020s, the program still carries substantial debt and continues to insure large numbers of repetitive loss properties. Recent attempts to introduce more granular pricing have again encountered resistance once the full cost becomes visible to homeowners. When financial protection and physical protection are both subsidized, the combined signal strongly encourages additional investment in hazardous locations. Incentive structures tend to favor the continuation of existing patterns unless the full cost of risk is reflected in ongoing prices. Complex systems that blend insurance, infrastructure, and local land use decisions rarely produce simple corrections once capital has been committed. The same tension appears today whenever governments offer below-cost coverage or protective works for wildfire, sea level rise, or other correlated hazards. How do we price protection without quietly enlarging the next loss? We'll leave it there for today. Thanks for thinking through this one with me. If you know someone who loves a good cautionary tale, send it their way, and I'll see you tomorrow with another. And if you'd rather watch than listen, find us on YouTube at NARA Network. Links in the show notes. And before you go, this show is part of the NARA Network, a family of daily podcasts on tech, science, and markets. Each one a short, sharp briefing you can finish on the commute. If today earned its place in your feed, here's your next listen, the Do Positive Pod. Good news in science and tech, plus one concrete action you can take. Find every show free at naranetwork.com. The Do Positive Pod is the club for people who do something about it, episodes, and the dispatch wall at naranetwork.com/the DPPOD. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.